Let's move on and get into conversation with Mr. Mark Matthews of Julius Baer to understand where the global macro setup is headed, what the global markets are up to. But first, Mark, hi, thanks so much for joining us. First of all, I want to get your sense on the entire India-UK FTA that we've seen. What kind of an impact could that have on both of those economies, and how would that position India on the global map?
I don't know what the impact is for the UK economy, but it's not big for India. As you know, UK-India trade is an extremely small part of India's overall economy. But what I would say is that it should be a boost for sentiment because they've been doing these talks for about 3 months, and hopefully will put pressure on the government to do the trade deal with the United States before the August 6th deadline, and that, of course, would be a much needed boost for the stock market if that comes through.
Hi Mark, morning. This is Shrishti also joining in. So the India-UK deal is through, but the other deal that the markets are waiting by is India and US. Mark, help us understand that any take on where you believe that this number will actually settle in, because the markets off late, they have been showing resilience despite some bit of a volatility in the earnings. But despite this, the other trigger will be the trade deal talks. Which number do you believe can be taken very well for the markets, and which number can actually be disappointing for the investors?
Broadly, I'd say I'd expect it to come in somewhere between 15 to 20%. So that's what I'm thinking. 20% being kind of the ceiling for the Southeast Asian countries like the Philippines and Indonesia. They're actually at 19%, and then 15% is the recent trade deal with Japan. So that's the kind of range I'm looking for. And I suppose if it was above 20, then I'd be disappointed. I don't know about the market. I mean, unlike Japan or the Philippines, trade with the US, once again, it's not material for the Indian economy. I find this is, frankly, more noise than substance.
Okay, so that's the deal, that's that view coming in right now. But Mark, I'm just going through your latest fact sheet. Amongst the preferred sectors with banks and consumption, I'm also seeing IT popping up. What is driving your conviction on IT, given the kind of earnings we've seen, B, the trade deal overhang that's still with us, because IT is largely an outward-facing sector for Indian companies. What are you liking within the IT pack right now?
I like two things. First, I like the fact that the sector's down almost 20% so far this year. So not across the sector, but there are pockets of very deep value. So this is a place in India where you can find deep value. And the second thing is that my sense was the guidance from management in the most recent quarterly results was largely positive, looking for better times ahead. So those are the two reasons why we like IT.
That's the take coming in on the IT space, but the other preferred sector, Mark, is actually the consumption space. Yes, of course, the discretionary plays back home, they have been doing very well. The staples have underperformed. Mark, anything fresh that you have added within the consumption basket, and what's your overall take on the valuations with respect to discretionary versus staples right now?
I don't have a view on that, I'm sorry, but I could just tell you what we think about the consumer is that it will be a beneficiary of the 1 lakh crore tax breaks that were announced in the budget back in February, and we should start to see that filter through, but also the 1 percentage point cut in the RBI's rate since, what was it, well, the last 5 months. Those two forces should be beneficial for the entire space. I would have thought on balance, probably for bigger ticket items like autos and property.
Okay, so those are the sub-themes that you're liking within consumption. But Mark, when we spoke about, when we interacted last time, you did say that gold seems overbought, and the kind of rally we've seen in gold was too much too soon. And now we're seeing exactly that playing out, that gold is softening now that we're getting some more clarity in terms of the trade deals, and you have equities that are doing well globally. What's your take on gold, and where do you believe gold could head as a commodity?
Well, I think I was wrong and I remember that conversation is probably higher than when we last spoke. Um, I felt that it was overbought because at that time I think it was up about 25% from the beginning of the year. Now I think it's up about 28%. Um, and I still feel that I think what I told you at the time is I preferred the idea of buying stocks in Hong Kong relative to gold. So I suspect on that basis, it might have been the right call. I think Hong Kong stocks have done better than gold since we last met. But yes, I mean, gold, if you look back over the last 100 years, its return is on average 5% a year in US dollars. So it's been a very fine investment, but it does move in spurts. And we've just had one of those big spurts over the last 2 years. So I would have thought it was due for a break. And it continues to go up. I mean, long term, I think the thing that speaks in favor of gold is that most central banks don't have enough of it, and they would like to diversify away from a very heavy concentration in dollars. In fact, there was a survey that came out last month that showed of all the assets that the major central banks of the world said they intended to increase their allocation to over the next 5 to 10 years, gold had the largest vote in favor. So I think there will be a steady buyer of gold from central banks, but they don't tend to chase the price. They tend to be very calm and steady in their buying of it. So I don't want to ramble, but I suppose what I'm trying to say is I felt and still feel that it's overbought in the short term, but longer term, it should continue to demonstrate that attribute of going up about 5% per year over the long term.
All right, point taken. That's the take coming in on gold. But Mark, with this, we'd like to thank you for taking the time out and speaking with